and a regular columnist with many leading publications like Fortune, Business World, and Outlook Money. He is currently working as a director of management consulting at PwC, and today he will be talking about how, as millennials, should we manage our personal finances. We are delighted to have you here with us, sir.
Thanks, Pradyuman. Thanks. Let me try and, am I audible?
Yes, we can hear you.
Is my screen visible?
Yes, your screen is visible.
Okay, great. So thank you, and good afternoon to everyone. Thank you for the generous introduction, and it's great to speak to all of you on a Saturday afternoon. Now, just for some context, when I used to be a student of business school, I passed out of IIM Bangalore many years ago, and we used to have these sessions on Saturday evenings where a guest speaker from outside used to come and address our batch. And I often used to think to myself, the guest speaker must be a real loser in life, that on a Saturday evening he has nothing better to do than come and address a few students. But as I say, karma is a bitch, and I am doing the same thing 10 years later. So just to give some context in terms of why this session is important. I passed out in 2009. After having done my MBA, I would say I have a fair degree of finance knowledge when I passed out, with a good understanding of corporate finance. I happen to be a CFA level 2, so I had a very good understanding of corporate finance, at least the theoretical part of it. But I had very little understanding of personal finance, how to manage your own money. And I can say that for myself, I can say that for a lot of my colleagues and batchmates who also passed out. And as a result, over the next decade, a lot of us made very costly mistakes when it came to money. And I will play out some of that. I mean, all of you come from IIT, you're much smarter. So hopefully most of you will not make the same mistakes. In 2010, I picked this book up called The Intelligent Investor by Benjamin Graham. It's one of the Bibles of investing, given that it's being hosted by the Finance Club. Some of you would have read it, some of you are going to read it. That book is the H.C. Verma of physics, if I were to use an analogy. And when I read this book in 2010, all the wisdom that Benjamin Graham spoke of was so commonsensical and so obvious. And I read the book, I was like, this is absolutely obvious. And over the next 7 years, all the mistakes he warned us against were made by me and were made by most of my friends. And when I read it in 2017 again, the same set of mistakes were made by me. So in that context, I want to have this discussion. So there are 3 or 4 questions I will try and answer in this session. The first one is in terms of why is personal finance important? And it's not just about the money and saving money, it's a little more than that. The second thing I will talk about today is what are the various instruments that are available. Now, a lot of you will be very well read with finance and a lot of you will know, but I'll give you some commentary in terms of each asset class, what drives an asset class, what is an asset class going to look over the next 5 to 10 years. The third thing I'm going to talk about is a lot of personal experience, and in terms of some of the mistakes we have made, me, my friends, and what are some of the mistakes you should avoid as you enter the workforce and work over the next 10 years. And the fourth thing I will answer is in terms of, for someone like you entering the workforce, you'll get into some of the best companies. You'll get into some of the, I would request everyone else to go on mute if that's all right. Some of the best companies, what is the allocation statement you should look at? And finally, I will take questions after that. So I intend to speak for about 35 to 40 minutes, and I'll take questions for about 20 minutes to 30 minutes after that. So this is how I plan to do that. If I may request everyone to go on mute if that's possible. Thanks for that. So this is the first question I'm looking at, is in terms of why this session is important for you. And I'm going to read from left to right. Now, it goes without saying that money is important, and that's why personal finance is important. The more you have in the bank, the better you sleep at night. But making more money is not a function of earning more, but a function of saving more, is what we have seen, especially for people like you in your early 20s as you enter the workforce, because the power of compounding kicks in. You take 100 rupees and you save it over a period of 10 years, you'll be amazed at what compounding can do to it. The second reason why personal finance is important is the more you have in the bank, the better you sleep at night. And there is the syndrome called the FIRE syndrome, financial independence and retire early. Some of you will be very high profile with your ambition. Some of you might want to start your own firm in the 20s, in your 30s. Some of you might want to just retire in your 40s. Some of you might want to travel the world. And the more you have, the better you will sleep at night. And the way you have more is actually saving more through smart personal finance. The third thing what I want to speak about, and this is the anecdote I was giving you, that when I passed out from an institute like IIM Bangalore and having studied finance, we had very limited knowledge of personal finance. And my third book is on millennials. And I have spoken to about 100, 125 millennials across the best of institutions like IITs and the not so best of institutions. And all of them have often said that we have very limited knowledge of our personal finance. How do we manage our money? And what we will see is as all of you go through your 20s, almost everyone, and I can say almost everyone, makes the same set of financial mistakes. And it's very important to understand what these mistakes are so that you don't repeat some of these. Hence, this session is very important. I would urge you to listen not just for anything else, but to just manage your own money in the future. The second question I am moving on to is where can you invest your money? So this is in terms of what are the various asset classes that are available. Now, all of you, I understand, are extremely well read. You will know a lot of this. Plus, please bear with me. I will start from the basics and then give you some commentary. So there are two slides in this. The first slide you will see, I'm going to read from left to right, are the asset classes of debt, equity. On the next slide, you'll see the asset classes across gold, real estate, and alternate assets. So for each of the asset classes, what I want to give you is a brief overview of the asset class in terms of what has been the historical return profile, what is the expected future profile, what is the kind of risk that is associated with the asset class, and in my opinion, is this asset class relevant for you or not? So when you see a green, it means it's highly relevant for you. When you see a yellow, it's a moderate relevance for you. And when you see a red, it means it's a low relevance for you. That's how you read it. So I'm going to start with the three debt classes. And the first one that you see is the debt risk-free. Risk-free is almost a guaranteed set of return with very little set of default. So these are some of the instruments available. So FD or a fixed deposit is what all of you are very familiar with. Just to tell you how a bank works, you put in an FD in a bank, it gives you about 5 to 6.5%. Currently, the bank takes that money, loans it out to someone else at 8 to 9%. The difference between what it pays you, 5 to 6.5%, and what it loans at 8 to 9% is called the net interest margin, and that's what the bank makes money on. The fixed deposits are fixed because of the interest rate. There's very little risk of default. But the issue with this instrument happens is all of you will fall in the highest tax slab. So you will end up paying 30% tax. So if you take 5.5%, remove 30% out of it, you essentially just get about 4%. Inflation in India is 5%. So you're actually losing money. So that's the commentary on fixed deposit. If you're going forward, the interest rates in India are expected to decline. So fixed deposit rates are going to decline, but there's a fair degree of guarantee. Some of the more interesting instruments come in are, these are more retirement vehicles, but are extremely strong because they are backed by the government. So I'll talk about the PF and the VPF, the Provident Fund and the Voluntary Provident Fund. So when you start getting into work, a Provident Fund is essentially you will contribute 12% of your basic pay, and the company will contribute 12% of your basic pay, and it's put into a corpus. That corpus is typically managed by the government of India. And the PF interest rates are fixed. The current rate is about 8.65% after tax. It is one of the best investment vehicles that are available because this is 8.65 without tax. So from a pre-tax perspective, that comes to 12.5%, and there is no risk because it's backed by the government of India. It's seen as a retirement asset, so you can't withdraw so much easily. You can only withdraw in chunks during special occasions like your wedding, buying a home, etc. The voluntary PF is an extension of the uh, PF because there is no cap of the 12%. So you can put any amount of your salary under this. This is currently a loophole in the investment cycle because this also gives you 8.65%. And this is no tax implication. Again, one of the best investment vehicles available because backed by the government of India and a guaranteed return. Now, the PF and the VPF, the interest rates are unlikely to come down significantly because there are huge labor unions that are highly dependent on this. The next thing is something called the Public Provident Fund, which is essentially you have a lock-in of 15 years. You get about 7 to 7.2% right now. Again, backed by the government of India. This comes with Section 80C. You can contribute up to $1.5 lakh every year. It makes a lot of sense because the lock-in is lower. The interest rate that you get is 7 to 7.5 and completely backed by the government of India. Similarly, the pension scheme that comes in, this is again a retirement vehicle. You can choose a combination. Most people choose a combination that is more debt heavy and you get a return of 8 to 9%. But under income tax exemption, you get a lower rate. Similarly, there are other instruments in the post office. You would have heard of Kisan Vikas Patra. Some of your parents will be doing it. You get between 7 to 7.5%, but you don't get the tax benefits. So if you fall in the highest slab, this becomes 5 to 5.5. And similarly, there are RBI bonds you can buy, which are again about 7.5 to 7.7%, but then you again have to pay tax for it. Now, all of these instruments that you see are risk-free. Are risk-free because either they are backed by the government or they're backed by the RBI or they're backed by a very big bank coming in. And they have a fair degree of return in terms of 7 to 8.5% is what you see. So in terms of the risk profile, these is extremely low. Sovereign backed, meaning the government is backing them. And for someone like you, this is highly relevant because from a tax perspective, they work very well. The next one I want to move on is I'm going on the risk continuum. So what you saw, the first line was zero risk. Now I'm going into quality, which means these debt instruments have certain risk, but a higher degree of return. So there are two things I want to talk about. One is the corporate AAA bond, and the second thing is the various public sector bonds. So how do you invest in them? You typically have a debt mutual fund. A mutual fund is a company that buys that invests in 20 to 30 securities rather than one security. So you'll have a mutual fund like HDFC and HDFC corporate AAA bond that will buy AAA bond across companies. So in terms of corporate AAA bond, it is a quality paper, which means the company AAA is a rating here, which means it's a quality paper. The return is between 7.5 to 8% historically, although there have been certain defaults, with IIFL being one of them. Similarly, there is corporate bonds which have been issued by the public sector banks. They are again between 6.5 to 7% return is what they give. The advantages, because it's a public sector banks, there is a backing of the government of India, so there is no loss of your principal. Now, in terms of tax, these work better than your standard income tax. So even if you fall in the highest category, you don't pay 30%, but you pay an amount close to 10%. There's something called an indexation benefit, but you end up paying about 10%. So 6.5 to 7.5 is what you can expect from these instruments. This is pre-tax. So after 10%, you will get about 6 to 7%. The risk profile is low. Doesn't mean there is no risk of default, but it's extremely low. And for someone like you, this is an extremely relevant vehicle. Now I'm moving to the third element of debt. And again, I'm moving on a continuum. So the first one I spoke was zero risk. Then I moved to quality instruments with some risk. And these are more in the element of risk. So there are two sets of typical mutual funds. One that invest in credit risk bonds. So basically, they invest in companies that rating is not as good as AAA, which means the credit worthiness of that company is not as high, but the company pays you a little more interest. So you can potentially get an 8.5%. For some of you who've been following the newspapers, Franklin Templeton had to shut down 6 of its funds. And this is the exact reason what happened. The underlying companies, in a way, turned junk. They couldn't pay. And a lot of people are losing their money. Similarly, there's something called dynamic bond funds. So for some of the finance students, you will know that the bond price and the interest rates are inversely related. If you don't know, it's okay. It doesn't matter if it sounds like Hebrew also, it's okay. So dynamic bond funds are essentially where the fund manager takes a punt in which way the future interest rate is going to be and the bond funds move. In terms of returns, they have been very patchy. These two categories, they've been very, very patchy because I spoke of the default here. The dynamic funds haven't done that well. So it can go from -5 to potentially 8%. There's a very high risk profile. And for people like you, I would strongly not advise this because of the amount of risk involved. Now, there's something of behavioral psychology which you should know with respect to how human beings operate. If you lose 1 rupee in a transaction, this is research and this is something called prospect theory. Some of you would have read about this. If you lose 1 rupee in a transaction, it takes 3 or 4 rupees of a positive gain to make up for the emotional upheaval. So that's the kind of risk we are talking about. To give you an example, I once invested in a dynamic bond fund, and in a way, I lost my principal. I lost about 10,000 rupees after a period of 3 years. So in my mind, just the emotional upheaval of that 10,000 rupees, I would have had to make a return of 30 to 40,000 rupees elsewhere just to be emotionally neutral. So this is basically called prospect theory, comes from behavioral psychology, and that's how much we all hate losing our hard-earned money. So in terms of risky debt instruments, I would strongly go against it. So the first three I spoke about are debt instruments. Now I'm moving into more equity instruments. And the first three you will talk about are mutual funds. Against a mutual fund invests in like at least 20 companies, stock of 20 companies. And the last line, what you see is equity, which just buys one individual stock. Now, if you look at mutual funds after the recent SEBI classification, there are essentially 3 or 4 key buckets. There's a large cap fund, there's a mid cap fund, there's a small cap fund. There are thematic funds meaning you can invest in particular sectors, pharma, IT, banking. And there are the international stock markets. These are the broad themes you will see with mutual funds, and I'll go through each of this. So large cap funds essentially are funds of the BSE 30, the top 30 companies in the Bombay Stock Exchange, or the top 100 companies. In terms of how this asset class performs, this asset class historically has performed at the nominal GDP of the country. So nominal GDP for some of you is real GDP plus the inflation. So what you read in the newspapers that India is growing at 4%, India is growing at 5%, that's the real GDP. India has an inflation of typically 4 to 5%. So the nominal GDP after factoring in inflation is real GDP of 5% plus the inflation of 5%, that's about 10%. So the large cap typically grows at the nominal GDP of the country. It is the biggest 30 or the biggest 50 companies. Now, if you look at the future, if you look at over the next 10 years or the next 5 years, inflation is supposed to be very low. It's going to be very low because crude oil prices are coming. So inflation is going to be about 4 to 5%, and the Indian GDP is expected to grow at 3 to 4%. So this large cap is actually going to give you about 7 to 8%, 4% for inflation and 3%, 3-4% for the growth of the country. So you get about 8% is what you should expect going forward. There's another principle with respect to large cap funds you should be aware of, which I'm fairly sure you're aware of. There's something called active investing and there's something called passive investing. So active investing is you have a benchmark index. So say the Bombay Stock Exchange top 30 funds, you have a fund manager who buys those 30 stocks but changes the weight in the portfolio because he believes some companies will do better. So he's actively changing the weight of the portfolio and actively investing, and he's trying to beat the returns of what the BSE 30 will give. Now, if he beats the returns, he also takes a commission, which is about typically 1 to 1.5%. Now, what has been seen with large cap funds is active investment is no longer working. These funds are so well covered in the media and the financial analysts that the BSE 30 prices capture all possible information. So if you're ever looking to make an investment in the large cap funds, you should typically go with a passive fund. So in terms of the future return, it's expected to be between 7 to 8%. There are taxation rules of about 10% that apply to equity investments. The risk profile is medium because these are large cap funds. India is still going to be a growing country, and hence I would say you can consider this for someone like you. The next thing I'm going to talk about is sort of the gold mine when it comes to mutual funds is the American stock market. Now, why is the American stock market important? So one, because if you see the Indian stock market and the American stock market, the correlation is 30%, which means if the Indian stock market goes down by 1%, there is a 70% chance the American stock market will go up by 1%. So this is in a way a diversification vehicle. The correlation is only 30%. Secondly, the American economy is a very, very strong economy. And in the next 10 years, with all the issues with China and all the businesses going back to America, the long-term decade growth of the American economy is very strong. Thirdly, today, when you invest in this, you'll invest in the dollar. You're also essentially betting on the US dollar. Today, the rupee is at 73, 75, and the long-term outlook for the rupee is about 100. So you will end up making a lot of currency gains. So this, in terms of the American stock market, has given you about 12 to 14% in the past. It is expected to continue in this range over the next 10 years. There might be a crash in the near term, but over the next 10 years, it's expected to be in this range. It is a risk profile because currently the stock markets are all overvalued. If you see the Nasdaq and the S&P, the American stock markets, but it's an instrument that is highly recommended for people like you. So how do you invest in the American stock market? There are specific mutual funds that do it. There's a Motilal fund, there's an ICICI fund that specifically help you do it. So I spoke about the large cap fund. I spoke about the American stock market. Now coming to the mid cap and the small cap. Mid cap and small cap meaning companies which are not at the top 100 in India, but say 200 to 500 in India, if I look at the value of the company. And thematic funds are essentially funds that invest in particular industries, whether it's pharmaceutical, IT, banking. Now, these asset classes are highly volatile. What happens is if you see the journey from 2011 to 2015, all of them went through a complete boom. But then they have completely crashed after the last 3-4 years. And some of the reasons have been because their governance has been questionable. Some of the numbers have been questionable. They don't seem as good. The models are scary. So these are questionable, especially in a down market. As we enter a down market, a lot of them are not expected to do well. So while they have given in the last 3-4 years about 4 to 6%, it's not expected to do as well. And the risk profile is high. For some of you, I would strongly advocate that you stay away from it. The next thing I want to pick about is in terms of equity instruments. This is where you buy one share of a company. Say you buy one share of a Unilever or you buy one share of an Infosys. Now, if you see the last 6 months, what has happened, so if you need to buy shares or you need to trade in shares, you need to have something called a demat account. You need a demat account and then you can actively, demat means dematerialized, which means it's an online trading platform and you have to buy shares. So in India, till about March, there were 1 crore demat accounts. And over the lockdown period, either people have too much time, the 1 crore has now become 5 crore demat accounts. There are 5 crore demat. So people are just going berserk on the stock market. People are just buying left, right, center. Now, I will give you an example, and these are certain mistakes I have made, and this is for your table. So if you ever get, a lot of you will get into banking jobs, trading jobs, never buy a share basis a rating from a newspaper. In 2015, I read one of these newspapers which spoke about this company called D-Link, and they make broadband routers, so some of you might know. And they said that this is a very good company. The prospects look extremely well. They did some analysis. This is one of India's biggest newspapers. I invested 7.5 lakhs of my hard-earned money in 2015. This year, I had to sell that investment off at 3.5 lakhs. So I booked a loss of 4 lakhs. And if I look at prospect theory, it will take me nearly 16 lakhs to just be emotionally neutral for that investment. So never invest basis a tip in a newspaper, no matter how credible, a tip in a magazine, no matter how credible. I would actually strongly advocate that you never invest in individual stocks because you take, in financial parlance, something called systemic risk. You are taking a huge bet on the company. It's always best to invest in a mutual fund. And given that where equity markets stand, you will see the markets, the BSE is currently at 39,000 with record P's, a crash is around the corner. So my personal advice for all of you is stay off individual equity instruments. The other thing you will see is when you get into your jobs is everybody believes once, including me, and not to say I have not done that, including me, that they are the greatest stock pickers since Warren Buffett or Charlie Munger have been born. So you will see a lot of your friends saying, you know, I have done this analysis. This is the greatest piece of stock. I'm going to put in my hard-earned money and I am going to become a millionaire. It rarely happens that way. So you should be very careful about this. So these are some of the instruments from a debt and equity side. I am on slide number 4. And I'm going to talk about some of the other instruments that are available right now. So one is gold. And You would have heard a lot about this. This is an asset class that everybody is talking about. So in terms of numbers, over the last 1 year, this asset class has grown nearly by 45%. It's had the mother of all rallies, and over 10 years, it's given about 10% now. So how does gold operate? So gold is seen as a safe haven. When people have doubt, they buy gold. You are concerned about the economy, buy gold. So that's how people operate. But the way gold works is for a large period of time, gold stays neutral in terms of returns. Even the last 10 years that you will see that a first 8 years gold wasn't really delivering any return. It's only the last 1 year that's made up for everything and giving 50%. Another thing with gold you have to know is that it is an asset that doesn't produce any output. So when you invest in an FD, a fixed deposit, you get a certain return. It is a tangible output that is coming in. When you buy a share, Unilever, the earnings of the company are going up. There is more cash that is getting generated, which is being paid to you. There is more output. Gold is just a instrument. There is no incremental output. People are just speculating on the price of gold. And this is how it is different from every other asset. However, in terms of risk profile is high, but it is a lot of people say that this is a very good diversification tool. And I will come to the weightages, but about 5 to 10% of your portfolio should be in gold. So how do you invest in gold? So you don't buy jewelry, because what happens with jewelry is you have to pay 20 to 25% wastage. There is a threat of is it original or not. So you don't buy jewelry. Do you buy biscuits? Sometimes yes, sometimes no. Because if you buy gold biscuits, then you have to maintain that biscuit. You have to store that biscuit somewhere. The way you buy gold is actually there are gold funds, the mutual funds that invest in gold. You either buy that, or there is a sovereign bond fund which the government of India gives and you invest in that. The next thing I want to speak about is insurance. And insurance, I will talk about medical insurance first and life insurance second. So medical insurance is an absolute essential for you. So some of the companies you'll work into will give you medical or health insurance, but you should definitely, when you enter the workforce, ensure your parents, your grandparents, any dependent sibling, definitely you buy medical insurance for them. The premium is about 10,000 a year, and that's what you should invest in. For some of you who want to understand how the insurance model works, is basically this. So you will negotiate, you as a consumer is negotiating with the company. You are telling the company that there is a chance of untoward event happening. That event could be I'm getting hospitalized, or I will die, or I will have theft. And the company says that, okay, you pay me a premium every year. So you pay me a token amount every year, say for the purpose of discussion, 10,000 rupees. And in case that event happens, I will take care of all your expenses. So that's how an insurance company works. Why does it work for the insurance company? Because they exploit something called the law of large numbers, which you all would have studied, that because they do this at such a huge scale and not everybody falls sick and not everybody dies, so the percentages start working in their favor. So that's how an insurance model essentially works. So a medical insurance is given. You should take it for your parents, you should take it for your siblings. Life and term insurance is a little tricky. Term insurance is basically you have insurance over a period of time. So term could be 10 years, 15 years, 20 years. In those 20 years, if something happens to you, the company will give you a compensation. Now, you should ask yourself if you really need a life or term insurance. If you have dependents on you, so your family is dependent on you, then you should consider, or else if your family is fairly independent, you should not consider. There are certain innovations in this industry. You would have heard of something called a unit-linked insurance product, a ULIP. Essentially, you pay a premium to the company, the insurance company invests that in the capital market, and along the way, if something happens to you, they also take care of insurance. So this is about 5 to 7% is given. So risk profile is medium. So my advice to you would be definitely have health insurance for your parents, for your siblings, for your grandparents. Life and term, you should evaluate in terms of do your parents really need that help? Now coming to real estate, and real estate essentially is, if you study the psyche of the Indian consumer, real estate is often seen as a status symbol. So if you go to a bar and if you tell someone I have a flat in Bandra West, you will definitely pick that person up. Or if you put it on Tinder that I have a flat in Bandra West, you will be number one on Tinder. That's how real estate works in the minds of Indians. So we will start with commercial real estate, and then I will go to residential real estate. So commercial real estate is what? Is essentially a company like, for some of you who come from, say, a city like Bangalore, you have a group which is Embassy. Embassy makes these office parks, these huge IT parks. You will work in some of them, and they own that and they make money through rentals. So, say Embassy has the office park, a company like Accenture might rent a floor and they will pay the rent, and the Embassy makes that. So that is commercial real estate. Commercial real estate can also mean warehouses. So Amazon has warehouses. If it rents it from someone, then it's part of commercial real estate. Can you invest in commercial real estate? The answer is obviously no. You can't buy a warehouse. The capital is so high. You can't buy an entire office. But there are certain mutual funds. For example, Embassy launched this mutual fund last year where you can buy a share of that office park. Now, if you see this asset class over the last 5 years, commercial real estate has been growing in India at 12 to 14%. Why has it been growing? Because companies need a lot of space. E-commerce has come up. The warehouses are getting sold. BPO sector is booming. So commercial real estate has grown at 12 to 14%. But over the next 5 years, from 2020 to 2025, when you come into the workforce, a lot of you will work from home. Not so many floors will be required. Hence, this is an asset class which is highly risky, and I would suggest to strongly stay out of it. Now, residential real estate. Residential real estate is a very important phenomenon. If you study the Indian consumer psyche, you have not arrived in life till you have an address that is envy worthy. Unless you have a flat, say the way Virat Kohli stays in Lower Parel, or uh, where MS Dhoni, the kind of area he stays in Jharkhand, you have not arrived with residential real estate. So what do you do for yourself? Is residential real estate a good investment vehicle? The answer is absolutely no. It is a terrible investment vehicle. Residential real estate should only be bought for you, especially for people like you. You should not think of buying it now, because some of you will go for higher studies to the US, some of you will go do your MBA, some of you will study. You don't even know which city you will be in. So for yourself, definitely not buy it for staying. If you're keen for your parents or your extended family in tier two cities like Jaipur, Baroda, Indore, you can consider that. But real estate residential is an extremely poor investment vehicle. And the reasons for this are the following. One, it is illiquid. Two, the industry has not grown for the last 5 years. If you see, the industry has been a complete mess. There is excessive supply. The prices are being artificially jacked. It is illiquid. Half of them don't follow the regulation. It's a complete mess, residential real estate is, and the gains you get are not good enough. When you evaluate this asset, there's a metric called rental yield, which you should all be aware of. So, for example, for some of you who come from Bombay, if a flat in Andheri, and Andheri is a suburb in Bombay, not one of the prime areas, but if a flat in Andheri costs 3 crores, and if you want to stay in rent, a rent will be about 70,000 a month. So you'll be paying about 8.5 lakhs rent in a year, 8.5 lakhs rent in a year on a base of 3 crores. That's nearly 2.5 to 3% rental yield. That means that's what the asset is earning for you. And this is extremely poor when it comes to India. Rental yields in the US hover around 5 to 6%. So real estate doesn't give you rental yield enough. Second, it's illiquid. The capital appreciation is not happening. So this is an extremely high risk item, and you should strongly stay away from it from an investing point of view. Even for yourself, you should not consider buying it for the next 10 years unless you want to be number one on Tinder. However, for your parents, dependents is something you can consider. The next asset class I want to speak about is emergency fund. And a lot of us assumed, at least when we were working, that my monthly salary, next month's salary is going to come, and I don't really need to keep a corpus for an emergency. So, what is an emergency? An untoward hospitalization. One of my friends drank so much that he had to get hospitalized overnight because his all the liquor from his liver had to be removed. And before we could claim insurance for 3 days, we had to pay a lot of money. So that's an emergency requirement. An untoward medical emergency can happen for your parents. There could be any form of emergency. Some of you could lose our job. Some of my batchmates have. So you should always have an emergency fund, about 6 to 9 months of your expenses. So some of you, when you start working, your monthly expenses will be about 40, 50,000 after you factor in your rent, or 30, 40,000. So 6 to 9 months, about 2.5 to 3 lakhs, you should always keep in an emergency fund, in a liquid instrument. That means which can be tapped easily. You have short-term mutual funds for this. And this is something I strongly advocate. Now, moving to some of the more exotic instruments, all of you will hear this story, at least all of us did, that one of our batchmates bought 100 bitcoins in 2012. Then it was 5,000 rupees a bitcoin. Then in 2015, that bitcoin went and reached 9.5 lakhs. Now it is 7.5 lakhs. He has sold off all his bitcoins and he's buying a flat on Malabar Hill. All of you will hear the story. I have never seen that person in my life. I can assure you, none of my batchmates have ever seen that person in life. So this bitcoins, cryptocurrency, they sound very sexy, very cool, but at the end of the day, there is no visibility. It is not controlled by the government. It's not controlled by the Reserve Bank. In my view, it is the ultimate form of gambling. And when it comes to your hard-earned money, you stay away from all this. And those incidents of someone bought a flat in Malabar Hill through your bitcoins, I don't think has ever worked out. Similarly, weapons of mass financial destruction. A lot of you will get into trading profiles. You will work on derivatives, the futures, forwards, options. And Warren Buffett famously called them weapons of mass financial destruction. It's one of the main reasons why the 2008 financial crisis happened. While you can engage in this professionally, you can never risk your personal hard earned money in these instruments. And always remember prospect theory that if you lose 1 rupee, it will take you 3 rupees or 4 rupees of gain just to stay neutral. So these are some of the instruments you can invest in. And when I take questions, I can talk more on these. The next question I want to invest is I want to talk about some of the mistakes we have made. I have made, my batchmates have made, and I'm fairly sure all of you will make, because when 2010 some of this advice was there in Intelligent Investor, all of us ignored it and we all made it. And nevertheless, let me try. So I am on slide number 5, and there are two sets of mistakes when it comes to personal finance. One is the lifestyle errors, and the second thing are more the investing errors. So when you look at lifestyle errors, the first thing is what you will realize is as you enter the workforce, because all of you will be earning such massive amounts, 15 lakh, 20 lakh, 25 lakh, 30 lakh, and 40 lakh in course of time. A lot of credit cards will reach out to you. A lot of banks will reach out to you. They'll say, take this credit card. You don't have to pay so much. If your expense is 50,000, you only have to pay 5,000. You can roll over credit. This is the worst financial mistake anyone can make, and I have made this, and I can talk from experience. Credit card debt is 24% rate of return. It is the ultimate form of fleecing that happens. And if you live on credit card debt, your CIBIL score, the score that evaluates your credit worthiness, can money be loaned to you, takes a huge hit. So in the future, you will not get home loans. So living on credit card money because the money is easily available is one of the biggest mistakes, at least I have made. The second thing, and this is especially important in a down market, that assuming your job is permanent. Now, one option is obviously because certain industries will have a downturn and some jobs will go. The other thing is you might not want to do that job. You might want to pursue higher education. Might want to pursue a startup. You might want to pursue your creative interest. So no job is permanent, and you should never think that my next month's salary will take care of my liability. It never works that way. So in terms of how you look at this is, if you are earning 100 rupees, if your take home is 100 rupees, 50 should always be saved by default. 50 should always be saved, and the remaining 50 is what you should run your life on. I think that's at least the cheat code I have developed with myself over a period of time. The third thing is spending more than what is necessary. This everybody will do. I have done it. I'm sure all of you will do it. When we started becoming flush with money, the first thing we bought is the iPhone, then the MacBook, then some nice sporting shoes. So everybody does it, and there is nothing wrong to doing it. You all have worked very hard in life. You've studied enough in life, and there is nothing wrong being a little consumerist, as long as you are robotic about this. That's saying that I will not spend more than 15% of my salary on this and stick to that cap. You'll be fine with this. And like I spoke about earlier, there is no emergency fund. This is very, very important. So I'm coming to the right-hand side, which is more in terms of the investing errors. Personal finance is not meant to be sexy. When personal finance, that's Ileana D'Cruz, by the way, for some of you. Personal finance, if it turns out to be sexy, that's when mistakes happen. What our grandmother used to say, that is essentially right. And like Charlie Munger and Warren Buffett say, managing money is the most boring job to do. So as long as it is boring, it is good. So it is not a poker table. It is not meant to be sexy. So if someone in a bar comes up to you and says, dude, I have this amazing tip. You put 1 lakh today in it and I'll give you 5 lakhs in the next 3 months. You stay away from it. That is not going to happen. If someone comes to you and says, I am an analyst covering Tata Motors, you put 1 lakh in it, it's going to become 3 lakhs in the next 3 months, is insider information, stay away from it. It doesn't happen that way. So personal finance is not meant to be sexy. The next thing is investing in instruments which you don't understand. And like I said, I gave you that dealing example when I put in 7.5 lakhs, lost 3.5 lakhs because a major newspaper had said it. It's a very, very bad idea. So if you don't understand that instrument, don't invest in it. When all of you get into the workforce and you make your huge bucks, you will have a lot of portfolio managers reaching out to you saying, we have made this amazing 3-type vehicle, 3-type instrument. It will give you this much return. It gives you downside protection. If you don't understand, if a person passing out from India's #1 institute, it doesn't understand that instrument, something is wrong. Do not invest in it. And the final thing is never invest in instruments which are not legal. So I know my friends have got into trouble with some P2P lending platforms. They've got into trouble with certain amount of Bitcoins. So if an instrument is not legal, don't invest in it. Remember prospect theory that for every 1 rupee you lose, it takes 4 rupees of gain to make up for it. And one of the biggest mistakes in personal finance, at least what I made, is never lose your principal. That is the ultimate mistake. So this is in terms of some of the common mistakes, and not just me, I'm sure all my batchmates have made, and I can even make this prediction all of you will make as you keep going into your 20s. The final slide before I start taking question is in terms of, so what is the ideal portfolio allocation for someone like you? And first, I will talk from a lifestyle perspective. So like I clearly said that avoid living on credit card money. It charges 24% interest. It affects your rating scores. So avoid lifting on that. One of the philosophies you should know is something called professional minimalism that comes from Japan. It's based on, it's a Japanese Buddhist principle that if you have too many things, it actually ends up messing your sanity. So in terms of credit card, you should have one credit card. In terms of bank accounts, you should have one bank account. In terms of instruments, you should have one master instrument. So you should always have minimal things. So there is, at least when I started working, it would look very cool that there are 4 credit cards in my wallet and it would look very nice, but it becomes a hassle. So you should only have one credit card and never live on credit card debt. The second thing, like I said, is when you get a salary, and this you should do this like a robot. At least I have figured out that 50 is a number that works for me, and you should agree to a number that works for you. 50% of your take home should just be saved, blanket. And how you will save it is on the right hand side. And the other 50 is how you divide, how you will run your daily expenses, your consumerist tendencies, going out, partying, all of that. So if say your monthly take home is 100 rupees for the purpose of discussion and you're saving 50, how do you save that 50 is on the right hand side of the page. So like I said, you need an emergency fund corpus. You need to build it up over a period of time. So if your monthly expense is 40,000 once you pass out, because you'll have to pay rent of 15,000 and your living expense, etc. So about 2.5 to 3 lakhs over a period of time you should keep as an emergency fund in case something goes wrong. Real estate, you should avoid. Commercial real estate, you totally avoid. Residential real estate, don't buy it for you. It's an extremely bad investment vehicle. Unless you want to support your family and your family stays in tier 2 city like Jaipur, Indore, Nagpur, etc. That's when it makes some sense. Insurance, I spoke about. You need to get medical insurance for your family in terms of parents, grandparents, and sisters. So this is in terms of more the one-time expenses, which are like a safety net. Gold is up to you. People recommend about 5% of your portfolio. And again, you don't buy a biscuit or don't buy the jewelry in direct form, but you buy a direct gold fund. So about 5% of your portfolio. If you believe this is not required, that is also all right. Now coming to debt and equity, and about 90-95% will be split between debt and equity. For some of you who will read or you've read a lot of finances, they have said that historically equity should be 100 minus your age in terms of allocation. So for example, you're 20 years old, your equity concentration should be 100 minus 20, which is 80% of your portfolio. So if your net worth is 10 lakh rupees, 8 lakh should be in equity. And this theory is actually flawed. This theory no longer holds good because the outlook of equity, like I said, is the nominal GDP in India especially is going to be 7 to 8%. And you have debt instruments like a BPF or a PPF giving close to 9% without any volatility. and equity is highly volatile. So that theory doesn't hold anymore. So in terms of the decade that you're getting into, where there's a down market, opportunities are not going to be as good. Some of you will decide to pursue your own creative way. Some of you become entrepreneurs. Some of you might become academics. Debt has to be at least 50% of your portfolio. And as you keep getting older, this number should keep increasing. And two types of debt you should invest in. One is risk-free debt, which is the PF, PPF, NPS, the post office, and second is the quality debt, which is the corporate AAA bond, the public sector bond, and this should be at least 50% in your portfolio. Some of you who are a little more risky can take equity to 25-30%. Some of you are really keen, but if you are risk averse, you should keep it to between 10 to 15% of your portfolio. And if you have to invest equity, it should only be in two segments. One is the large cap, like I mentioned, because they are more stable, they will reflect the nominal GDP. And you buy a passive large cap fund, because an active fund where the fund manager is changing the weight in the portfolio hasn't really delivered. A passive fund is something that replicates the BSC, and that is what you should buy. And the second investment you should make is the international market, especially the American international markets through mutual funds. So this is my view of what an ideal investment portfolio for someone like you should be. And given that these are branding platforms and I'm fairly shameless at branding, so I am fairly active on LinkedIn. So if some of you want to talk to me, stay connected, please do send me a connection request on LinkedIn. You want to bounce certain ideas or please reach out to me. I'm fairly active. I will definitely respond. I have a channel on YouTube where I talk on some of these contemporary topics. And I have 2 books on Amazon. Do check them out. And my third book is on millennials, where I talk of certain topics like personal finance. So do get in touch. And this is what I had to speak. And I'm happy to listen to your thoughts or take questions now.
Right. So for asking questions, you can either type it down in the chat box or you can unmute yourself and speak out.
Yeah, hi, this is Sudhakar. Hi, Sandeep. Thanks for the session. It was very wonderful and useful. So I think in terms of the home loan, in terms of residential investment, I think you've given some insights. So, example, what do you advise in case the people who already have a home loan? What do you advise? Whether try to, the home loan interest is less. Is it good to put more on home loan and close the home loan, or instead of
You're
closing home
saying
loan?
should I prepay it or should I follow the regular schedule? Is that the
Yeah.
question?
Should I prepay,
Yeah,
or instead of
follow the
pre-closing it,
regular
should you
schedule.
invest it?
Okay, so it's a very good question, and the way to analyze this is actually a mathematical answer in terms of see, if you see home loans and the interest you pay, there are some tax deductions you get. Okay, so now, for example, if your home loan rate is say 8.5%, and the tax deduction after that you get is say 30%, so that potentially becomes 7%. And now the way you have to evaluate is, do I have an instrument which is giving me at least 7% uh, with limited volatility? In certain cases, the VPF is the answer. The VPF gives you 8.65. So then 8.65 is greater than 7, that technically you should let the home loan continue, because sorry, if you're getting 7%, you have an alternate instrument. You should close the home loan and put the money in 8.65. That's what you should do. But if you do not have the instrument, if your other opportunity cost, as we call it, the other instrument is only 5.5, 6, and so that's how you typically evaluate what is my opportunity cost of how much money I will make, but how much money am I giving. But this is a mathematical answer, and this doesn't work in the real world. Most people and most consumers like you and I, how we will think is debt is bad. Debt is bad because it doesn't help you sleep at night. And if you have the ability, you should clear it as soon as possible. And that is the answer that will make you happy. The first answer is an analytical answer, which will not make you happy. That's the short answer.
Sure, thank you.
Hello. Hi, Sandeep.
Yes.
Uh,
Yes.
So, thanks for your session.
my
It
question
was
is,
quite insightful.
what are your suggestions?
Is that Aditya speaking? Or is that Deepak who's speaking? Is that Aditya?
Hi, I'm Deepak.
Oh, hi, Deepak. Please go on. Yes, I'm happy to listen.
So, your session was quite insightful, and thanks for that. Uh,
Sure.
so, I wanted to know what are your thoughts about the future industry's growth, because things are getting digitalized more now, and after the COVID, the industries which will grow up is quite. I mean, it's quite ambiguous. What can we say about that? So I wanted your bit of insights over the industries in terms of stock market.
Sure, sure. So, there are certain industries that will do fairly well. So, for example, if you look at FMCG, that will do fairly well, especially companies with respect to food, companies with respect to health. You will have pharma companies who will do very well, especially medicines. You will see companies in agriculture do very well because, as you would have read in the newspaper, there's been a huge monsoon, there's been a bumper harvest. So FMCG, pharma, agriculture will do all very well. Companies that will, or industries that will struggle, are largely the service oriented firms. So your hotels, restaurants, hospitality, flights, these are the companies that will really struggle going forward. But if you are looking to make a long-term investment, all of this resurgence is over the next 12 months, people believe things will become normal. So if your investment period is, say, 15 months, if your investment period is 3 to 5 years, this will not matter. But if it's more short term, go for FMCG, agri, and pharma.
And for the long terms, like 5 to 10 years.
Long term, Deepak, that's a very good question. You know how I would invest if you want to invest in the equity market? Just buy any mutual fund that replicates the BSE 30. And the BSE 30 will automatically adjust for companies that are doing well. So you don't have to think, just put it in the passive BSE 30 and it will do well. But long term, what will do well? See, FMCG will always do well. Long term, if you see construction companies, infrastructure companies, companies related to solar will do very, very well in course of time.
Okay, thank you so much.
Yeah, thanks,
Thanks.
Deepak. Hi,
Hi,
Aditya.
hi,
Please tell me.
Aditya this side. Uh, yeah, actually, I had a question regarding what ratio that we should generally prefer to invest in terms if we are looking for equity investment or some sort of portfolio investment if we wanted to. So, do we need to make it in a ratio, invest it in some ratio
Sure, sure.
for long?
Sure. So Aditya, yeah,
What
if
is
I get your question, if you are earning, say for the purpose of discussion, 100 rupees a month, you are saying how much of that 100 I should invest in the equity market? Is that your question?
exactly?
Okay. So Aditya,
Or one
yeah,
question,
yes.
additional question: should we always go through mutual fund or mutual investment, or should we just we can go directly
Okay.
about it?
Okay. Two very good questions. So firstly, Aditya, my view is that if you are earning 100 rupees a month, 100 being for the purpose of discussion, in my view, you should never cross 30 if you're extremely aggressive, because the next 3 to 5 years, equity markets are going to be subdued. If you are conservative, stick to 10 to 15. If you're more aggressive, go to 30. That's first part of your question. The second part of your question, and this is more an individual choice, I would recommend you go through the mutual fund route rather than picking individual stocks. Now, the reason I say that is a mutual fund will always have more analysis, will have the best of data systems, and because they're investing in a large portfolio of companies, the risk in a way is diversified. Now, when you pick a stock, pick one stock, there's something called systemic risk. You're betting on an entire company with information as a retail investor you might not have. So my personal viewpoint is over a period of time, go for the mutual fund because of diversification benefits.
Okay, thank you very much.
Yeah, thanks, Aditya. Yeah.
Hi, Sandeep. I have a few questions about how a lot of us going forward will probably have to worry about buying, let's say, cars or spending for masters and higher education. So,
Yes,
how do you
yes.
suggest going about that? Do we take a loan? And if yes, then what kind of precautions are we supposed to take?
Gayatri, this is a very good question. I can uh, tell you some of what my friends have done and what we did. So I'm assuming if you go for your master's and say you work for a couple of years, that's scenario one. Try saving. All of you will get into high-paying jobs, so try saving some amount on your own. which you can use to fund the masters. If say you are going for a master's immediately and you're not going to work, it is you. It's honestly in terms of, so the option is, do I take the loan, the massive loan in dollars, or do I ask my parents to help? It's a personal call, honestly, in terms of how fluid the situation is. If you believe, a lot of us come from middle class, upper middle class families, and for us, a lot of US education meant that if I have to use my dad's income, a lot of his retirement savings would go in that. So at least if I had to do it, I would have never taken his income. I would have taken the loan, and my dad's savings would have been my like last resort if things horribly go wrong. So my personal advice to you is, I mean, most of us will come from middle class to upper middle class families, that take the loan, and your family's nest should be your last resort. Now, if you're obviously coming from an affluent background, then please go ahead, and if your dad can fund it, there's nothing like it. Yeah. Gayatri, I hope that answered the question.
Yes, it does. Thank you very much.
Okay, thanks, Gayatri. Yeah.
Hi, Sandeep.
Hi.
Hello. Yeah,
Yes.
so like I wanted to ask that first of all, you kind of advised against individual stocks,
Yes.
but suppose if we have to buy, what are some metrics by which we could judge if we should buy or not?
Yes, Ardeep, you are sort of going to make the mistake which I made, but I will still answer your question. Okay,
Okay.
if you have to, no, there's nothing wrong investing in individual stock, but it is just that. See, there is a quantitative evaluation and there is a qualitative evaluation. Now, quantitative evaluation is some of the metrics that you will see are, how is the revenue growth been for the last 3 years, top line, the sales growth. Second, how is the profit growth been for the last 3 years. Third, most important, how is the cash flow? One is the financial statement. How is the actual cash with the company? The fourth you will see is something called a PE ratio. I won't explain the ratio, but it basically means a company is overvalued or undervalued. There is a deviant of this ratio called the PEG ratio, price earning to growth ratio, which also basically indicates if the company is overvalued or undervalued. So these are 5 metrics which will give you a quantitative view of the answer. You also have to do a qualitative evaluation in terms of what is the outlook of the industry in the next 3 to 5 years. How is the company placed in terms of market share? Is it doing well? Is it likely to do better? And is it doing better than competitors? Is it doing worse than competitors? So once you take a look at all of this, it is a subjective call which people make after looking at all of these parameters.
Right. Okay. Thanks.
Thanks, Harshdeep. Yes.
Hi, my question is again on home loans.
Yes, Sudha.
I see so many of my relatives in their 30s taking home loans worth crores, and
Yes.
they defend that it's a good investment to make, or I mean, they have their own reasons. And there is another section of people who think that taking home loans of such great amount is not such a great decision. What are your views on that?
Yeah, so that's a very good question, because what happens is, if you take too much, uh, debt is the ultimate killer in our kind of market. If you have too much loans, you won't sleep at night. It's normal human behavior. My personal view is, the loan you take should be a function of how much your savings are. So, for example, if my total net worth or total savings are, say, 1 crore, I should not take a home loan more than, say, 1.25 to 1.5, because I know in case something goes wrong, a majority of it I can still service. If my net savings are 1 crore, I should never take a 5 crore loan, because you will not sleep well at night. So the loan you take should be a function of what your net worth or your savings are at that point, so that worst case, you can manage 80% of the loan. I think that's the way most people should think.
Okay, thank you very much.
Thanks, Udaya.
Hello, Sandeep.
Yes.
I have one more question.
Please go on,
In
Aditya.
terms of educational loan, what should
Yes.
be the ideal way? Many people, because many people prefer to take loan, and they say that it can act as a tax, as a measures for tax, to save the tax deductions, and many people actually avoid it to take those hefty loans. So what should be the ideal way according to you?
Yes, so Aditya, one is a quantitative answer and one is a qualitative answer. The quantitative answer is you have to see what the education loan rate is. I'm assuming it's around 10% with the latest MCLR, so 10%. And how much tax benefit are you getting? So say you get a percent and a half, so it becomes 8.5 to 9%. So 8.5 to 9% is what you are paying. And so how much are you earning from an asset? So 5.5 to 6%. So it means you should pay that loan out as fast as possible because you are actually earning little lesser. For instance, if your education loan rate was 4% and you know there is a PF instrument that gives you 8.5%, then it makes sense to keep the loan because you are also earning 8.5. So this is the first analysis people should do, that after tax, what is the rate I'm paying? The second thing is, in my view, and this is the most psychological qualitative answer, that you should pay off your loans as soon as possible if you can. Because the lesser loans you have, psychologically, you will sleep better at night. Hope that answers your question, Aditya.
Yeah, thank you so much.
Yes.
Yeah, I just had one question, sir.
Sure, please go on.
Yeah.
Can I ask a question? Hello?
Is that Sai Venkat speaking?
Yes, thank you, Sandeep, for the session. My doubt is when we are newly entering into the saving our portfolio, how to approach like various forms of mutual funds should be present. Like how to find like should how much time should we spend or choosing a mutual fund? Like
Yeah.
is there a procedure?
Yeah. No, it's a very good question, Sai. I should have touched upon it. So the way I have done it, Sai, is there are two asset classes, first of all, I would recommend. One is the large cap and one is the American stock market, like I said. Now, where do you get all this information? So there's a site called valueresearchonline.com. Value Research Online. For some of you who are interested in a career in finance, I would request you to go to that site. And you can actually see the performance of all mutual funds. So if you just go to a category called large cap and Value Research Online, you will see all the large cap mutual funds that are available. Now, when it is available, how do you make a decision that which is a good mutual fund? So one is, obviously, you see the 1 year return, the 3 year return, the 5 year return. You also see how many crores of the asset they are managing. A larger fund in general means it's a better managed fund. So you look at the assets under size and the returns, and on that Value Research site only, there'll be a link. You can click on that. It will take you to a place where you can buy it. So that's how you choose a mutual fund.
Thank you.
Yeah, thanks, sir. Tulsi, you had a question,
Yeah,
right?
yeah.
Please go on.
So I was saying that what would you comment about trading versus investing? And what are your comments for that? Which one is better?
See, I am not the expert, Tulsi, so I will tell you what I know. I have not directly worked. Trading is more short term. Trading is more daily patterns that you see. There are a lot of mathematical charts which map human behavior at a mass scale, and it will give you certain patterns. And wherever there are anomalies, you make short term money. Investing is more where you invest in the business basis, the long term, 1 year, 2 years, 3 years. I think there are both are schools of thought, and what I have read, and I could be wrong here, that investing is where you make more money over a period of time. Trading is more short term. You win some, you lose some. Net, you don't make too much. So my personal view has been investment is the better school of thought. But I also know my friends make crores running trading desk arms of banks. So that is also there. But my personal opinion is investment always works better.
Does that trading involves a full-time activity? Like for investing, we can just have we don't need to spend so much of time. But I think for trading, we have to invest a lot of time per day. I think, is that correct?
Tulsi, yes and no. See, trading basically means what? You are looking at a lot of numbers and a lot of charts, and you're looking at past data to predict some anomaly. So you'll have to read a lot of those charts on a daily basis. You'll have to be very good with numbers. You'll have to spot those anomalies. So that way it can take you more time. But it is not to say that investing will not take you more time, because with investing also you have to read up on the business. You have to understand the business in terms of why you are. So today, if you want to buy Unilever stock, those numbers which I spoke about, revenue growth, cash flow growth, will not tell you anything. You have to really understand which category will grow. And that needs a different kind of effort. That needs more business judgment. This needs more mathematical capability, but the effort will be largely similar.
Okay, okay. Thank you so much.
Thanks, Tulsi. Yeah.
We can have two more questions.
No, Pradyuman, we can go on. It's all right. Yeah. I'm happy to see this engagement. I'm happy to answer as many as people have. Whoever wants to go next. Should I read from the chat portal? There are certain questions on the chat portal.
Hello, Sandeep.
Yes, please go on.
Yes, Sandeep, myself, Anandu. So
Yes,
my question is, see, what if we have invested in mutual funds and, for example, some kind of a global recession or a pandemic like COVID comes? So obviously the market will go down globally. So is it
right.
a good option to, withdraw our funds or like be it there?
That's a very good question. So I will give you the theoretical answer and then I will give you what happens on the ground. The theoretical answer is that if you believe your investment is fundamentally strong, so if you are investing in a large cap fund, the biggest of companies in a country like India, you know over a period of 5 years they will do well. So you should not pull money out. That is the theoretical answer. What happens on the ground is, and when some of you will put money into the market and your hard-earned salaries, that when you put 10 lakhs and when you see the next day that becomes 5 lakhs, panic will set in and logic will go out of the window. And when that panic sets in, most people start selling. When they know they maybe the market will come back to 20 lakhs, but people will start selling. So the way to overcome this is to have a portfolio balance where these volatile instruments are not more than 20% of your portfolio. If your 80% portfolio is solid in terms of say zero standard deviation and only 20% is variable, you're emotionally better equipped to take this decision.
Okay, Sandeep, thank you.
Thanks, Anand. Yeah. Pradyuman, should I start reading from the Samaj? Should I start reading on the chat window?
Yes, sir. You can read those questions.
Okay. So I'm starting with someone has asked that real estate prices, houses keep increasing. Well, that was an assumption for a long time. If you've seen the 2008 financial crisis or seen the movie called The Big Short, that need not hold true always. Some of the prices have been kept artificially high. The bigger issue with real estate is that it's illiquid. So at the time when you want to sell, you will not get the right buyer. So moving to the next question in terms of, isn't the US the only country who uses credit score? No, India also has credit scores. There's something called CIBIL, and India also has that. What about hybrid mutual funds? Can it be used instead of passive index fund? No, the functionalities are different. A passive index fund is where a fund manager just replicates BSE 30. A hybrid mutual fund means the mutual fund invests in both debt and equity, and both could be active. What's the difference between equity and debt? So debt is essentially when you give, so I am giving person B a loan and he will pay me an interest. That is debt. Equity is when I'm buying a share in the company and I'm a part of the owner's capital and I will share the profit. Your opinion on multi MLM, I assume, is multi-level marketing. It's a slightly complicated question, but I'll skip that. Could you elaborate on sovereign gold bonds? Is there an interest on the bond? Yes, it's 2.5%. You should read about this. It's given by the government of India. You can buy certain bonds, the prices appreciate, and it's a guaranteed return of 2.5%. You also have tax benefits. Do you recommend investing on our own or availing the services of an investment manager? This is Karthik's question. I recommend neither. That neither should you invest on your own, neither should you take an investment manager. You should just buy a passive fund and leave it at that. Please recommend online portals through which we can invest and build our portfolio. So what you need is a demat account, and any of the banks you have a salary account with, HDFC, ICICI, they can open a demat account for you. Current GDP of the country is, I'm going to Rahul's question, current GDP is 24%. How long do you think the recovery will be? Most people believe, Rahul, that it will take another 4 quarters for things to come back. Siva's question is, you recommended BSE 30, why not Nifty 50? Both are identical. I was just giving BSE 30 as an example, and index fund Nifty 50 also works. I'm good. Rituraj's question, how good is to invest in property? Very bad idea. Please avoid. Saurav Kumar's question, at what point of time should we switch from renting to buying a house? This is a very good question. This honestly comes down to the stage of life you are in. If you're married, you have kids, people generally go to buying a house. It's not a mathematical answer. And Sudha's question, I've had a few friends who make 30-35%. Isn't that amazing investment policy? Sudha, this is the same example. I think she asked me a question earlier. So that's the same Bitcoin story. You will hear a lot of stories. That person bought 10 Bitcoins. Today he has a flat in Malabar Hill. You should check the veracity of this claim. I don't think it happens so easily. If it was so easy, every smart IITian would have done it. Can you elaborate? Arun's question is, can you elaborate on emergency fund? This is basically a corpus you keep, like a piggy bank for an untoward emergency. John's question is, can you provide investment book mentioned at the beginning? Yeah, the name of the book, John, is Intelligent Investor. It is by Benjamin Graham. You can just look it up on Amazon. Yeah, these are the questions. So
Yeah, Sandeep.
yes, Ashdeep, please go on. Yeah.
Yeah, regarding books, like, could you mention some books for beginners, like who are trying to find their way in personal finance? Like, can
Yeah,
we read
Ashdeep,
Intelligent Investor?
no, you can't. To be honest, you can't. And I don't want to be shameless, but you should definitely pick up my book when it comes next month. That will explain a lot from the basics. But I mean, on a serious note, you can't, Ashdeep. It is difficult. But give it a shot, Ashdeep. Give it a shot. Yeah, you all come from IIT. You are the smartest people in this country. I found it difficult, but you guys will be much smarter. Maybe you will find it easier. But yeah, you can definitely pick up my book. That I assure you, you will understand. So, yeah.
Okay.